Hello and welcome to Week in Markets. I'm joined by Matt Henderson, Portfolio Manager. It's been a volatile week for financial markets this week, and it's been all dominated about tariffs that were announced on Wednesday. Matt, let's start with tariffs. What was announced and why has the market moved so much?
Yeah, thanks, Paul. So what the market had been expecting was that we would see reciprocal tariffs on Wednesday come through. So if some of the US's trading partners had placed a 10% tariff on the US, they were going to place that tariff and match it back on them. But what we have seen actually come through is tariff rates that are over and above that, but then also placed on countries who the market hadn't been expecting.
Exactly, and it's been done on trade imbalances. So if you're exporting much more goods to the US, then we're going to take that into account and put on appropriate tariffs. So it's got nothing to do with what tariff measures countries are putting on the US. So it is certainly wasn't expected, and we've seen markets have to adjust accordingly. Let's just focus on market moves. What have we seen if we think about equity markets, I think bond markets and alternatives? What are the moves?
Yeah, so I think the majority of the drawdown that we've seen has actually come through within equity markets. So if we look at something like the S&P 500, say, so the main index within the US, we've seen that index, if we account for what's happening at about the time of recording whilst the market is open, we're down about 16% since the peak within that market. But I think for us, Paul, as investors, is what's important to note is that the environment is different to what we saw during 2022, where if we look at fixed income markets, they've actually worked as a diversifier in this environment because we're really thinking about what could change in terms of GDP growth rather than the threat of inflation that we saw in 2022.
And I think that's a really important point that we often talk about the role of diversification, and it has proved its worth over the course of this week with bonds rallying, so yields lower, prices higher, offsetting some of the losses in equity markets. We've also seen gold perform well. It's continued to hold up after an exceptional run, which is encouraging. I know a number of our managers have been allocating there. If we think about volatility, that's prices higher and lower, up and down repeatedly, and could be quite aggressive. What's the message that you would want to give to clients and advisors around volatility and the risks around it?
Yeah, so what we would say is just focus on the long-term investment goals. So what we've done is a little bit of analysis just to look at what would happen if you missed the top 10 daily returns in a global equity market. And what we can see from the chart on screen is that your return is about 110% lower if you only miss those top 10 days over a 25-year investment period. What we would also like to add to that is those top 10 days account for about a 64% return. So it's through the power of compounding where we see that return move up to 110%. So we think it's really important for clients to remain invested, don't get panicked by the headline volatility and the volatility that we're seeing within asset markets, and focus on that long-term investment horizon and allow those returns to compound.
And I'll just build on that. It's never easy in times of periods of volatility. So if you do have issues or concerns, you should always reach out to your financial advisor. Okay, if we just think about tariffs and where next, what will governments be thinking? What's the next tact from governments looking forward?
Yeah, so we're unlikely to see foreign governments from the US take these tariffs well, because they'll view them as being unfair and unwarranted and unjustified. So we're likely to see some sort of response, and that's actually what came through this afternoon. We've seen China place a 34% tariff on the US for US exports to China, and that just matches the tariff rate that the US has already placed on China. We're likely to see other governments try and negotiate with Trump because, as we know, he's always trying to find some sort of deal. So it's likely for some governments that they engage with Trump, agree some sort of trade deal with him, and we actually see a step back from tariffs.
And I think it's worth noting that since Donald Trump's been come into power, he's come through and threatened a number of tariffs. I think he's come through with 22 separate tariff announcements, but the majority of those haven't actually been implemented. He's actually walked back from many of them. So he has come out quite aggressive with these tariffs, but expectations that there'll be some walk back, some renegotiation, but it'll be on a case-by-case basis. I suppose what we are seeing in the US equity markets is a significant drawdown, that's true, and so far Trump and the administration has kind of really shrugged its shoulders, gone, okay, yeah, but we're not changing tact. At some point, if the markets get low enough, there has to be some adjustment. What Trump is doing is destroying wealth, and importantly for the government's perspective, will be destroying much needed tax receipts. So nothing as of yet, but certainly that's what we would expect going forward.
And if we saw any further persistency of tariffs that continue to be weakening for growth, we could ultimately see this feed into labour markets, where we could see firms start to actually step back from capex or capital expenditure plans, also look to reduce staff count. So if we get into that environment, people who had supported Trump in the US might actually start questioning it, where they could be in a scenario where they've lost their job and also their pensions are lower because of the destruction of wealth that you've mentioned. So Trump could also change tack because of a loss of support in the US.
I think let's just build out thinking about the economic impacts of tariffs. We talked about the hit to the household consumer in the US markets. We talked about higher prices, weaker growth. How might the rest of the world be faring?
Yeah, so the rest of the world could actually do a bit better out of this scenario, because they're likely to come together to develop new trade routes. They're also likely to see lower inflation because of what we're seeing within oil markets. So OPEC has looked to increase its production of oil in this market volatility period, looking just to gain market share relative to US firms. So we've actually seen oil prices come down quite significant, which is likely to be inflation downside surprises coming through in those other countries.
Yeah, I think oil prices were down 7% yesterday, 7% today. So that's a material fall, and that will feed into the inflation basket, particularly for the UK. So that's one small positive, if there is one. I suppose thinking about our managers here at True Potential, there was a lot of focus on the tariff announcement on Wednesday. What were the changes, the key changes that the managers have been making, would you say? Yeah,
so the changes that we've seen actually come through from our managers have actually been done before Wednesday's trade announcement, which we think's an important thing to highlight. But what we've mostly seen from our managers is actually look to reduce their risk exposure, and that's majority come through in equities. So managers have looked to take down equities and allocate into sovereign bonds, where they've just detected that there could be a change in growth assumptions.
Super. Right, let's just finish off with key messages for our clients and advisors to take away.
Yeah, so the two main ones for us are remain invested, think about the long-term investment horizon, and don't be pulled into short-term market volatility and headline volatility. And we'd also note that the environment is different to what we experienced in 2022, where the main threat to equity and fixed income markets was inflation risk, whereas this time it's more centered around GDP risk. So inflation diversification is actually working within portfolios.
Excellent. Well, thank you, Matt. And thank you very much for watching. We will see you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.